What if I told you your shares can earn you extra income without even trading them? You've heard about earning rent via property, but what if you could earn rent from your stocks? That's exactly what SLBM or stock lending or borrowing mechanism allows you to do. We briefly discussed about this in our passive income video, and a lot of you asked for a detailed explainer on SLBM. So here we are with a full breakdown on SLBM. How does this work? What returns you can expect? And can you actually earn additional income without selling your shares? Here we are going to discuss 7 key things that you absolutely need to know. And we will be uncovering them one by one. So let's begin. Securities lending and borrowing mechanism is a way via which the investors can temporarily lend their shares to other traders for a stipulated time and fee. And you'll be surprised to know that this mechanism is not a recent development. It came in existence in 1997, then it was revised in 2010 and later became popular in 2012. Let's understand the process of SLBM. Meet Ajay, our lender friend, and Meera, our borrower friend. We will be explaining the process of SLBM via their example in this entire video. Step 1. First, both of them will go to NSE website, then to market data, and then to securities lending and borrowing. Here they will find all the stocks that are eligible for SLBM transaction, along with the offer price from lender and bid price from the borrower for the lending fee. Ajay is a long-term investor and has 100 SBI shares which are trading at 800 rupees. He plans to lend these shares. So he will approach his broker to lend these 100 SBI shares at a lending fee of 1.2% of the total value of the stock, which will be 960 in total. Now Meera, our borrower friend, on the other hand, reaches her broker to borrow these 100 SBI shares, and she is willing to pay 0.8% of the total value of the stock as her lending fee, which comes down to 640 rupees in total. Now the order matching will take place on this lending fee, similar to trading on the exchange. Let's say the order matching happens at 1%, which means the lender will get 800 rupees in total, whereas the borrower will have to pay 800 rupees as the lending fee. Once the order matching is done, both the lender and the borrower will have to fulfill their obligation. Ajay's account will be debited by those 100 SBI shares, and on the next day, Meera's account will be credited with those shares. Once the contract comes to the expiry, then Meera will have to return these 100 SBI shares along with 800 rupees as lending fee. Mind you, SLBM contract has a monthly expiry like that of an FNO contract. But unlike FNO contract that expire on the last Thursday of the month, SLBM contracts expire on the first Thursday of the month. And in case if that day is a holiday, then the contract will expire on the next working day. Also, one can roll over SLBM contracts like that of FNO contract. One can roll over for 1 plus 11 months, where 1 is the first month of the contract and 11 is the number of times you can roll over. Therefore, on the NSE website, you will see the contracts active for 12 months. Now that Ajay's account is debited with 100 SBI shares, meanwhile, what if a corporate action is announced, like dividend, buyback, stock split, etc.? There are actually 2 types of contracts, Series A and Series B. If you have placed the order under Series A, in that case, if any corporate action is announced, the contract will foreclose before the X date. But let's say you have listed your contract under Series B. In this case, dividend and stock split, the contract will not be foreclosed. But for other corporate actions like bonus issue, buyback, open offer, etc., the contract will foreclose. If a dividend is announced, in that case, the exchange will take that dividend from the borrower and then will give it to the lender. And in case of the stock split, the borrower will have to return the adjusted quantity before the expiry date. For example, 100 shares were being borrowed by Meera, and let's say SBI announced 1:10 stock split. In this case, those extra 1000 shares, Meera has to return them as well to Ajay before the expiry of the contract. Now, if you are thinking which series to choose from, Series A or Series B, then go for Series B because it has more liquidity. Now that you have majorly understood the transaction, let's understand benefits and risk from the perspective of Ajay, our lender, and Meera, our borrower. So for Ajay, our lender, the sole reason he will be lending his share is to earn additional income on his stocks without even losing ownership of the same. And they will get this additional income once the contracts come to an expiry and the borrower pays them back the lending fee. But what if the borrower defaults? By borrower's default, we mean what if Meera is unable to give back those 100 shares? In this case, exchange will carry out the auction for those shares. Ajay, via auction, will get back his 100 shares and Meera will be making the payment for those shares. Along with that, will also be giving 800 rupees as lending fee to Ajay. But what if nobody sold the share in the auction? In that case, to do good with Ajay, Meera will be giving him the value of the share along with the lending fee. But since it will be treated as a sale transaction, that is why if there is any gain, Ajay will be liable to pay capital gain on that additional income. Also, when the lenders want the share back before the expiry of the contract, they can do so by recalling these shares and placing a recall order under the same series in which they have lent. However, there is no guarantee because it depends on the price and the open orders. The lenders can call back their shares on the market price if they need those shares back urgently. Now, coming to the borrowers, there are actually 3 reasons why a borrower will be borrowing the share via SLBM. Number 1 is to short sell. We know that you can either short the shares in intraday market or F&O market. But if you want to short the shares in delivery trade, that you can do so via SLBM transaction. See, you borrow the shares from the lender, you short them in the market, later on you buy them at a cheaper price and then return these shares back to the lender. Let me explain with the help of an example. Meera borrowed 100 SBI shares from Ajay which were trading at 800 at that time. She believes that SBI shares will fall to 775. Over a month, the stock comes down to 775 and she buys those shares at that price. This way, she earns a profit of 2,500 rupees. Now, she will return those 100 shares back to Ajay along with a 800 rupees lending fee. So in total, she made a profit of 1,700 rupees. The second reason is to settle the short delivery trades. See, when you short the stock intraday, you are supposed to buy it back the same day itself. But what if the stock hits the upper circuit and you are unable to exit? Then the transaction is completed the next day in the auction. But when you buy the stocks in the auction, it can be comparatively expensive as compared to paying a small lending fee in the SLBM trade. Therefore, borrowers often choose SLBM trades in order to cover for their short position to avoid settlement failure. The third reason is to take advantage of cash future reverse arbitrage trade. Let me explain. Let's say SBI is being trading at 800 in the spot market, but it is trading at 790 rupees in the future market. Now, ideally in the future market, the stock is supposed to be trading at a higher value. But when you see such mispricing, there is an opportunity of arbitrage. The idea is simple. Sell the spot at 800 and buy the future at 790. On expiry, the future cost to carry becomes 0. The futures price and the spot's price becomes the same. And that is how you can make a risk-less profit of 7,500 rupees. So basically, you will make risk-less profit of the difference between the spot and the future price, that is rupees 10. For example, one future lot of SBI is 750 shares. So you buy one lot of futures of 750 and you sell 750 shares, and that is how you will be able to make a profit of 7,500 rupees. Such an arbitrage where you sell the spot and buy the future is called reverse arbitrage. Here is the problem though. You can buy the future, but how can you sell a stock that you don't already own? In such a case, you will not be able to participate in the reverse arbitrage trade. that is where SLBM comes to the rescue. In this case, you can borrow those shares from the lender, make the reverse arbitrage trade, and later on give those shares back to the lender. However, there are two risks to the borrower as well. Number one is, what if the price of the stock goes up instead of going down? This way, the borrower does not only lose the money in the market, but also has to pay lending fee to the lender. And number two is the risk of foreclosure. The foreclosure can happen because either of the two reasons. One, if the lender recalls the order, or second, in case any corporate action is announced. In such a case, the market might not be in the favor of borrower, and when the foreclosure of the contract happens, in that case, borrower might lose money in the market. Also, like the lender had the recall option, the borrower has a repay option, wherein they can return the shares to the exchange even before the expiry of the contract. When the shares are returned, the exchange will reverse the margin amount. Talking about the margin, the borrower has to maintain a margin before they can initiate the SLBM transaction. Ideally, they have to maintain a margin of 125% of the value of the stock. For example, 100 SBI shares trading at 800, so the value of the stock is 80,000 rupees. So borrower, which is Meera, has to maintain a margin of 125%, which is 1 lakh rupees. But ideally, Meera only has to maintain a margin of 25%. Let me tell you how. See, when Meera borrows the share and later on when she is going to sell them in the market, immediately she will get those 80,000 rupees back, which means she only has to maintain 20,000 in her account. Now coming to the additional features, number one is about taxation. From lender's perspective, since the shares are temporarily transferred from one demat account to another, therefore they look like a sale transaction, but it is actually not because the shares are returned to the lender. Therefore, in this case, lender is not liable for any capital gain tax. But whatever income the lender is earning via the lending fee is treated as income from other sources and will be taxed accordingly. Now talking about the borrower, when they borrow the shares and then they sell and buy in the market, whatever money they make in this process, they will be liable for the capital gain tax. Now coming to feature number 2 is about charges. So no STT charges, no stamp duty charges, no transaction charge and no SEBI turnover charges. But brokers do charge commission on the transaction. The commission could be different from broker to broker. One such broker charges a commission of 20% on the lending or borrowing fee plus 18% GST. To give you an example, those 100 SBI shares where price was 800 rupees, the order value comes to 80,000, but the commission is not charged on this number. The lending fee is 8 per share and the total lending fee was 800 rupees. So now the commission is charged on this 800 rupees, which is 160 plus 18% GST, which is 28.8. Therefore, Ajay will not be getting the gain of 800 rupees, but after settling down all the commission charges, he will get 611.2 rupees as his gain. Coming to the feature number 3 is about returns. The returns depend upon the demand. For the popular stocks, you can demand a lending fee of between 0.5 to 1%, which comes down to 6 to 12% annually passively by the stocks that you already own. However, there is a catch, and that's feature number 4 about volume. There are enough lenders in the market, but there aren't many borrowers in the market. The borrowers are increasing, but not by that much amount. Therefore, it can be difficult to consistently earn 0.5 to 1% on monthly basis because of demand and liquidity problem. Okay, by now if you're wondering how to place SLBM orders, is there a terminal like the way we put orders for our normal stocks? Then let me tell you, there is no such terminal where you can place your SLBM trades. You can actually check the SLBM prices on NSE's website, and then you can approach your broker, which will help you place your orders for the SLBM transaction. The SLBM market is open from 9:15 a.m. in the morning to 5 p.m. in the evening. So since the orders are directly placed by the brokers, you need to contact your broker for more detailed information. Largely, this is how SLBM works. But there could be nuances that are specific to a broker, so do discuss with them. Lastly, now let's come to the things that you need to remember. Number 1, SLBM is only available for selected stocks approved by SEBI. Number 2, tenures are fixed, so you can't exit midway unless you place an early recall, and even that is not guaranteed. Number 3, SLBM is ideal for long-term investors who don't trade frequently. And number 4, lending fees are taxable as income. So, SLBM is a low-risk, passive income opportunity for long-term investors. It will not make you rich overnight, but it is a smart way to earn income from the stocks that you already plan to hold. I hope you like this detailed explainer. See you in the next video. Till then, happy investing.